today, looking at Lemonade making a nice jump in response to its own corporate earnings release. Joining us now for more on that is George Tsilis, senior markets correspondent. George, this is not one that I've spent a lot of time over the years looking at. Just by chance, in case our viewers have not watched this one closely, can you give us a brief idea of what this company does, and then, of course, the earnings results?
Yeah, so this is essentially a diversified insurance company. They actually use AI technologies, so primarily they're property and casualty insurance, but they do offer, various other insurance alongside things like property and theft, hurricane and homeowners insurance, rent, car, pets insurance, and also life insurance. And it's been growing its top line sales quite considerably over the past few years. I just looked at a longer term chart. It was actually trading, going back to 2021, about $190 a share. So it's still down significantly since, of course, that year. And that was the year where we saw a lot of these upstart companies that essentially got such a benefit from that tech bubble that we were in, actually that overall stock market bubble, especially with low interest rates. And now the company's starting to generate some generous revenues, but at the same time, when they reported earnings today, their metrics for free cash flow were actually quite promising. So let's take a look at the overall numbers. The numbers came in with a loss of 95 cents. The estimate was a loss of $1.02, so it was significantly better than the estimated loss. But their sales number was higher by about 19%, 136 million, versus the estimate at 126 million. But they talked about how their in-force premiums were higher by 24%. Their customer count increased by 17%. And the kicker is, if you look at the breakdown of their sales number, 136 million, they posted free cash flow of 48 million. And that was significantly higher than the same quarter last year, where they only generated 3 million. So what we have here is essentially a company that is starting to generate free cash flow, very generous amounts of it. Still not profitable, but they did guide for adjusted profits in 2026, because prior to the announcement today, the expectations for consensus estimates in 2026 were still a loss of $1.78. So they're expecting profits coming up in the next couple of years. Plus, if you just look at the forecasted sales for this name, they're expecting on average about 23% top line sales growth for the remainder of this year, but also in 2025 and 2026.
So, George, we've talked a lot about some of these winning themes, and shockingly to me, I feel like Warren Buffett was one of the first that was credited with this theme, but insurance has been a really winning and viable business this year. And so, why is this really? Because the more and more I'm aware of these insurance companies, the more I'm they're all outperforming. So this is, I feel like, a broader story than just obviously Lemonade specific, although this is what I use for my own renter's insurance, so I'm a little biased because this is a great company.
Yeah, it's a great question. So a couple things to note. First off, insurance companies are major bondholders, so their contingent claim reserves are really invested in treasury bonds, so they've gotten a windfall with higher interest rates. The second thing is pricing power. There's still lots of competition in the industry space, but a lot of the reinsurance businesses have consolidated, and the larger property and casualty insurance companies have actually merged over the last year. So there's been a lot of pricing power. And in fact, one of the culprits for service inflation has been insurance. It's gone up tremendously, exceeding inflation rates over the past couple of years. That includes homeowner insurance, car insurance, and even property and casualty insurance across the board. So pricing power and interest rates have benefited this entire group. If you look at this stock, it's up actually tremendously over the past year, and it's starting to look promising from the standpoint of sales and that free cash flow as well. But the other thing to notice today is you'll see a company called Root, ROOT. That is another AI-powered insurance company, which was up tremendously earlier today. So I do suggest that some of this movement in this group, I'm going to put Lemonade in that same group as well, has been a short squeeze, because Lemonade still has about 22% short interest. And I did notice that Root also has about 16% short interest as a percent of the free float.
George, you mentioned free cash flow, which looked like it was positive this time around, but it's not expected to stay there really consistently yet. when we're looking at this company that is still losing money both on adjusted EBITDA metrics as well as EPS from an operating standpoint, they're not reinventing the wheel here. I guess you could argue with the AI, they're doing something slightly different, perhaps more efficiently. But this is insurance. This isn't rocket ships.
That's right. I mean, insurance business and underwriting of insurance has been around for a long time. The actuarial science has improved marginally over time. But I think what's happening here as well is technology has actually made insurance pricing more dynamic. For instance, tracking driving behavior can actually adjust your policy prices quite frequently. That, again, offloads the risk for the insurance company to the insured individual or individuals. So the insurance company with insurance industry, let me put it that way, with more data, more information, can price risk more efficiently. So that's also one of the issues that I think is suggestive of higher premiums, but also higher profits for this whole group. So, and you're right, if you do look at the notes the company provided as to why the free cash flow was positive, the reason they denoted was less of a hurricane season adjusted contingent claims. So they actually didn't have as much offloaded cash policies because of things like hurricanes and floods.
Yeah, and I think a really good point there, and a good name to look at, frankly, because it's following suit with so many of the other trends that of the winners we've seen on the year. So appreciate it. George Tsilis, as always, senior markets correspondent for the network.